This is the Rational Reminder Podcast, a weekly reality check on sensible investing and financial decision-making from two Canadians. We're hosted by me, Benjamin Felix, and Cameron Passmore, portfolio managers at PWL Capital.
Welcome to episode 291. And Ben, I don't know about you, but I feel super rusty. I don't know, our cadence is different this year. It's been great with a lot of great guests and stuff going on. It's just a little different.
The cadence has been different. I'm not feeling that rusty because I've been trying to do more videos on my YouTube channel, and so I've been spending more time sitting in front of the sitting in front of the camera
For the money scope.
True. Well, there's money scope, but also on my YouTube channel, I've been posting more videos. I haven't done one this week, but been trying to be more consistent with that. Anyway, in this week's Rational Reminder episode, we welcome back our friend Robin Wigglesworth. He had a couple of articles that really just caught our eyes, and so we asked him if he'd want to come on to chat about them, and he was willing to do so. So we talked about the Quant winter, which was a period that listeners who have a value tilt in their portfolio will remember well, as we do, from kind of 2018 to 2020. There was a pretty ugly drawdown for
pretty chilly.
Yeah, pretty chilly. And a lot of the quant and factor managers really felt that pain. And so Robin did some really good reporting on that for an article. And we talked to him about that. We also talked to him about private credit, which is something that we've been hearing a lot about, and he'd written a couple of nice pieces on that. So that was a nice conversation with Robin Wigglesworth. And then Mark McGrath joins us for the first mark-to-market of 2024. We're all already done with the first month of the year, and we're doing our first mark-to-market because, like you said, our kind of cadence has been a little off. But we talked with Mark about Canada Pension Plan, which is a surprisingly divisive topic. I don't think it should be, as we discussed with Mark, but it is.
And complicated.
Yeah, the complexity is not controversial, but the concept is controversial, and I don't think it should be. But we'll try and explain that in the segment with Mark.
And then with some luck, I'm actually going to do a quick review. We'll talk about our episode when our friend Alexandra Macqueen was on to talk about annuities, which kind of links into the discussion we had with Mark about CPP. And then we have the Aftershow, which for the three people that stick around, we got a lot of reviews to go through, and we got a lot of other stuff going on, which we can cover off. I also wanted to share a bit of a story. I'm in the office every day, as I think many people know these days, and one of our advisors, Brady, is also in the office every day here in Ottawa. He's just commenting in passing, Ben, the other day about how much fun he's having meeting new people who are actually reaching out through the podcast, through Mark's Twitter feed, your Twitter feed, and people are actually engaging virtually and kind of keeping an eye on us and following us and our information, and then going to the Calendly links in Mark and yours bios in X, Twitter, and just kind of booking automatically. But he's talking about the great pleasure he's having meeting people that kind of feel like they know us, they kind of know what they're looking for, and they're looking for something different. And he's just having these incredible experiences, as are all of our advisors right now. I happen to be chatting with Brady about it. So I thought that was just an interesting phenomenon, how there's people out there who are engaged with what we're doing and reaching out. It's just, it's, one of our objectives is to really help Canadians, help impact them on their finances, how they think about their finances, and to see, the work we're doing in things like this podcast and Money Scope and papers that you write, etc. It's nice to see the people reaching out.
Yeah, it is cool. We got more deliberate over the last year or so about saying that we're taking clients, and if people are interested, we'd love to hear from you. And just saying that seems to have made a big difference in the number of people that are reaching out. So that's been cool to see, and it's good to know that Brady and the team are having fun with it.
And we're very grateful. Cool.
Certainly.
So with that, let's go to our episode then.
Let's go.
All right, welcome to episode 291. Ben, do you want to tee up our conversation with our pretty good friend Robin Wigglesworth? He's become a friend. He's always great to chat with. I had a chance to meet him when I was in London last year, which was really fun. Good guy. So with that, why don't you cue up our conversation?
Okay, sure. So we both read his article, A Quant Winter's Tale, in the Financial Times, and it really just piqued our interest because it told a story that we kind of lived, maybe to a lesser extent than Cliff, who's featured in the article, but we certainly went through it too. Robin is the author of the book Trillions. He was our guest in episode 184, so listeners will probably remember him. He's the Financial Times Global Finance Correspondent, and he's also the editor of FT Alphaville, which is the FT's financial blog. So that there's the article on December 14th, and it's not paywalled. You can read it. Anybody can go and read it. It's a really nice, easy read. And he's also written a bit about private credit recently. So since we were talking to him, we asked him about that as well.
Okay, so let's go to our conversation with Robin, and then right after Robin, we jump to our conversation with Mark for this week's Mark to Market.
Robin Wigglesworth, welcome back to the Rational Reminder podcast.
Thanks for having me back on again. Clearly, I didn't scare you guys off the first time.
No, you definitely did not scare us off. You wrote a couple articles recently that we want to talk to you about because they just really caught our interest, and I think they'll catch our audience's interest as well. Can you talk about what quant investing is?
Oh yeah, one of my favorite subjects. So I guess it's just, people would like to call it scientific investing, but the way I most usually use the phrase is systematic investing. It's rules-based investing. It's like if this, then that. And at its simplest form, it can be an index fund that says buy all the stocks in the S&P 500 according to their market capitalization. An ETF is a quant product, really, a quantitative investing product. At the most sophisticated on the other side of the spectrum, it is, hedge funds like Renaissance, DE Shaw, Two Sigma that use the whole gamut of artificial intelligence to basically kind of intake all the data that is out there in the world, everything that happens online any day, any second, and parses it using things like machine learning to find signals, quite often very faint, sometimes signals that don't really work for very long, and systematically mine them, essentially. So it's basically something that isn't a human portfolio manager sitting there saying, I think Apple is going to have good earnings this quarter.
So your article talked about AQR, and Cliff Asness was in the article, who our audience knows. What does a quant shop like AQR, like how do they differ from a firm like you mentioned, Two Sigma or DE Shaw?
Yeah, so this is something that people sometimes forget or lose sight of in that, like systematic investing, quant investing, it's, a very disparate group of strategies and types of strategies. Like I mentioned, obviously, there's a big difference between Renaissance's medallion fund, which is something called the stat arb fund, statistical arbitrage. That's the sort of very fast machine learning-y kind of stuff that we don't know exactly what they do, but we know probably the broad contours of it, and an S&P 500 index funds. It's not really a clean spectrum, but you can kind of put AQR in the middle there because they do something called multi-factor quant investing. So they mine what academics and quant investors have found to be, in theory, durable signals. So these aren't the kind of things that come and go from minute to minute, day to day, the kind of stuff that lasts ideally for years, maybe centuries across all markets. So the tendency of small stocks to do better than large stocks, for example, or cheap stocks to do better than expensive stocks. Now, that doesn't always work. This isn't the kind of thing that is always going to be working. You are going to have bad years, as Renaissance, I think, hardly ever has, but you can do it at scale. The problem with the kind of stuff that Renaissance does, or DE Shaw or Two Sigma, is that there's a limit to how much money you can put to some of these strategies, because then those signals, they're so faint, they disappear. With factors, or smart betas, it's sometimes called, essentially there's infinite capacity, at least in theory. This is something you can do at great size, and that's something that AQR has been a real pioneer of. They were a hedge fund, and they do a lot of hedge fundy stuff, but they've also take these signals because you can do them at scale and package them up and sell them to other investors as well. And you have other firms like Dimensional Fund Advisors, Acadian, Arrowsmith. The multi-factor quant world is large and diverse and fascinating, at least to me.
You reminded me of something that Cliff Asness told us when he was on our podcast. He said something along the lines of, the difference between us, AQR, and Medallion is that we'll take your money.
Right.
Yes. I'm a big fan of index funds. I literally wrote a book about them. But like, I put my money in Renaissance and Medallion Fund. In fact, I'm pretty sure every investor in the world would.
Right.
I do think I'm not in the efficient market zealot. I think smart people can beat the market. I just think it's very hard. It's far harder than people commonly understand. And if you look at every single top-notch investment manager that has durably done this, they're all closed. So yes, you cannot give your money to Renaissance Medallion Fund. Two Sigma is shut down. DE Shaw is shut down.
Wow.
Millennium, Citadel, also heavily quantitative in many respects, also close to new money. AQR is very keen on your money, especially, frankly, after what we saw factor investing did over the past 5 years or so.
Yeah, can you talk about what happened to factor investing between 2018 and 2020?
Well, the short answer is we don't really know. There's lots of theories, right? But I mentioned that factors cannot work all the time. And there's reasons for that. There's, again, theories behind it, but we know they don't always work. Sometimes they might have a bad day, sometimes they might have a bad week, sometimes a bad month, sometimes a bad year, sometimes, perish the thought, a bad decade. And some factors can go through very short, painful bursts. So momentum, for example. So that's a tendency to, you can actually systematically take advantage of the fact that if the stock's gone up for a certain amount of days, it tends to go up for another day. Same thing, we've seen these trends in all sorts of markets, and you can systematically try and surf them almost. But occasionally it works very badly and you get your face ripped off. So momentum does really well until it does terribly for a day, week, a month. Value is a classic factor. It was existed as an investment style before even computers existed. This was kind of what Ben Graham was really doing, was value investing. And he didn't call it systematic investing. There weren't these words. Value investing can go through longer periods. It tends to not have these kind of face-rippingly bad days, but it has face-rippingly bad years, sometimes decades. The ideal thing, if you're an AQR, especially, or some of these other multi-factor quants shops, is that you use multiple factors. So the idea, you try and combine the ingredients in a way that even if one essentially, sorry for my language, sucks, the other ones should do better.
Right.
What was value had been doing really badly for a long time. But then from around 2018 onwards, we saw everything else also, to use Cliff Asness's technical word, suck, or at least not do as well as they should. So essentially the combined result was something that people call the quant winter. So it was a good 2, 3, 4 years where, again, Cliff Asness's favorite word, everything sucked.
And how did this quant winter affect the level of assets in the factor-based strategies?
Well, value was the worst affected. So you saw a lot of systematic value shops, so quant shops that just did value or some flavor of value. They did terribly. Several shut down. We saw some value-oriented discretionary managers do badly. Value, just as a style, an investment factor, whatever way you call it, cheap stocks did badly, and expensive stocks did really well in basically the decade after the financial crisis. And that hurts some of our AQR strategies, for example. And if you're invested in a dimensional value fund, you would have had a terrible noughties. But broadly speaking, you combine these things, right? You don't just do this one thing, or you use it as a counterweight to something else. And until 2018, AQR was still growing massively. At their peak in 2018, AQR was the biggest hedge fund group in the world. I mean, lots of that was long only, it wasn't in hedge fund strategies. They managed well over $200 billion. So they were bigger than Bridgewater at that time. But then value went from bad to just awful. And a lot of other factors just stopped working. And if you talk to, some quants, they'll have all sorts of theories. Some people think it's the fact that there is some sort of almost semi-mystical bond or link between the level of interest rates and factors, the performance of factors. Some academics and quants think that, maybe, you need a certain amount of interest rates to get these things to work for some reason. And there are again theories behind that. I'm not quite convinced, just because I think you can backtest and show correlations between anything you want. And I don't think we don't have a good rationale for why that would be. Why would these things not work as well? Maybe value works better in higher interest rates. Maybe, I don't know. But from 2018, we can see a lot of other things. And I think Cliff Asness's argument, I've heard this from other quants, is that all systematic strategies, whether they use multi-factor quant or anything else, will have a valuation bias. Like, you try to avoid buying really stupidly expensive stuff. So even if you have, let's say, a quality factor or a momentum factor, you have like an implicit bias in your models towards value in those things. So as value just basically stunk out the place, it kind of infected all the other factors because there was a value bias in all sorts of other factors. This was particularly what AQR thinks happened to it. And I wouldn't be surprised if there are elements of that elsewhere. But, there are theories that some of these things cannot work. We know in financial markets that as soon as somebody discovers something and publishes about it, that the impact of that, the effect of that kind of disappears, or at least decays. It's called alpha decay. And, some people just thought that some of these factors were just so well known, there was so much money chasing them, that they just went away until essentially people pulled the money out. AQR over halved in size from their peak. And then now things are good again. We have a quant summer. Lots of these quant strategies are doing really well again.
After that really bad quant winter, how do you think investor sentiment about factor investing has changed?
Well, it's definitely changed. I mean, some of it was kind of wrapped up in the like, I remember I wrote an incredibly badly timed piece about basically essentially saying, oh, this is the future. And it was kind of, luckily, it wasn't on the literal cover of the Financial Times, but it did suffer from a classic magazine's curse because factor investing started stinking quite soon afterwards. But in 2018 and 17, around that time, there was a real sense that the future is systematic investing. Again, like a Two Sigma, a D Shaw, a Renaissance are all closed. So if you're a big endowment, an ordinary investor, a private bank, this is the next big thing. And clearly it just kind of makes intuitive sense. Don't give your money to some guy sitting in Los Angeles or New York or Mumbai or Delhi or Dubai, and he picks his best stocks and avoids the worst ones. Kind of doing this rigorously, like with like rules, it just makes sense that it should work. And it did work. So there is a lot of money that went into it. And there's this phenomenon called algorithm aversion, which is really fascinating. Have you heard of algorithm aversion?
No.
So essentially, there's a paper that studied how we humans react to when machines go badly, or how we perceive when they go badly. So essentially, it gave people a bunch of like human forecasters of the weather and a computer model of forecaster of the weather. And humans trusted the machines a little bit more than the humans until the machines made one mistake. Even though the machines was clearly better than the humans, more accurate than the humans, as soon as the machine made one mistake, we lost all trust in them.
Wow.
The same way that humans, human money fund managers and investment styles have bad months, years, perish the thought, even decades. As soon as something that was supposed to be this super cerebral, systematic, not infallible, but pretty close to its system failed, there was, I don't think if you talk to Cliff or anybody else in the factor world, I don't think they would call it aversion. They would just call it a full-on investor, like puking. Nobody wanted to touch this stuff. We are talking hundreds and hundreds of billions of dollars. that left these strategies overall. Actually, you'd be surprised. I'm almost surprised that there wasn't more, given just how bad performance was for a period. But I think, again, investors also, there's an immense amount of inertia, but we also know there's lots of money in terribly performing active strategies as well that never leaves year after year. But the money's come back a little bit recently, but it's interesting that we've had at least 2 good years now from a lot of these strategies. Fantastic to okay years, and investors haven't really rushed back in yet, as far as I can see.
Yeah, the algorithmic aversion thing is really interesting. I remember one of the other things Cliff said when he was on was it's a lot easier to live with for investors to live with bad performance in a beta strategy, like in just an index fund, than it is in anything that is different from the index.
Yes.
Yeah. No, I mean, so I've had this argument with him before, and it's one of the reasons why, although I'm personally intellectually intrigued by systematic investor and factor investing, I think it makes sense, and I think probably works in the long run. We're not machines ourselves, and we need to be aware of our own biases, and it's just easier to stick with a strategy that does exactly what it says on the tin. It's one of the reasons why, in every bear market, or ahead of every bear market, active managers always say, oh, passive funds will be proven to be terrible. When the market goes down 50%, the fund will be down 50%. Everyone's going to bail out of index funds. And lo and behold, it never happens.
Right.
Because look, if I have an index fund and the market's down 50%, that fund is down 50%. Look, I'm not happy, but it's done what it's supposed to do. What we hate is being missold something that said, oh, this will do really well in the bear market, such as active management. And active managers on average do worse in a sell-off. That's why active managers tend to lose more assets than passive funds by far in every single bear market we've seen since the 70s. And I think with factor investing, it's kind of the same, that, Cliff and other quants in the factor world will talk about no pain, no premium. That the reason this works is because it's so hard to hold on to. And again, that, I don't know how rigorous it is, but it makes intuitive sense to me, that this is essentially a pain premium you are systematically harvesting. But we're humans, we're not good at pain, and certainly not financial pain. So if the entire edifice of factor investing is built on the idea that most people can't hang on, that strikes me as a very bad strategy for the vast majority of humans who should just stick to super cheap plain beta. And this is, Cliff obviously disagrees with me, but he thinks that he and other people in that world need to get better at making people hold on for dear life, as the Bitcoiners would say.
No pain, no premium makes sense. And I think it's also when the pain shows up. Like you look at the quant winter, it was like when the world was seemingly collapsing, that's when value did really, really badly. So it's came at a bad time.
Yeah, I mean, it was super bad timing, and it was the pandemic, because essentially, so value had done terribly in 2018, and that hurt AQR. It done really badly in 2019, and that's when AQR decided we're going to lean in a little bit on value. And you see a few other shops do the same thing, because basically value, and you can measure the valuations and like how cheap is value versus like how cheap it normally is. Like value stocks are cheap stocks, so they're generally speaking always cheap. In 2019, it was kind of .com levels. It was extreme, the wildest we've seen for a long time, pretty much ever almost.
Yep.
And this was after a very long drawdown. So it was both severe in size and duration. I saw one quant that calculated you could extrapolate going back to the birth of the stock market in the 1700s, and value never had such a long drawdown either. So lots of quants and, discretionary, normal human fund managers said value is going to come back in 2020. And then COVID came and smacked them in the face. It was just brutal. It was just the ultimate rug pull, right? People were positioned for value after 2 terrible years having the mother of all comebacks. They leaned in on it, and it went terribly. And that's why you saw in 2020, that was a real capitulation moment for a lot of these strategies. People, a few prominent names that literally retired, they couldn't hack it anymore. And ironically, obviously, that was pretty close to the bottom because almost exactly when we saw the vaccines, the announcement of the vaccines in November 2020, you saw the first snapback. And since then, it was just been better and better and better, broadly speaking, for a lot of these strategies.
So are you saying that the quant winter is over?
If I say that, obviously it's going to come back, knowing my history of predicting these things. Yeah, I think the quant winter, the 2018 to 2020, is over. That doesn't mean we can't have another one.
Right.
I mean, in many ways, I guess it's a good thing that money hasn't come rushing back into these strategies. But the extreme in valuations for value stocks, if you look at high price versus low price, is still pretty, it wasn't as extreme as it was in mid 2020, but it's pretty wild still. So that's why people like AQI still, they're actually super happy now. Most of the performance has been phenomenal the past couple of years. Um, but this will happen again. And, you know, it's you can prepare yourself for a bad year, maybe in a bad couple of years, but a super stinky 3 or 4 years, it just gets hard, right?
Yep.
So can these factors last forever? I don't know, but maybe the whole idea needs to be essentially sort of demystified and say that look, most human fund managers, when they describe the process, will say we'll try and buy good companies at reasonable prices. I mean, it's kind of the classic Buffettism. That's kind of what, let's say, a quality factor does, or a quality with a value tilt. I mean, so essentially they're just doing what a lot of human fund managers already do, just far more cheaply, essentially. So my hope is that the prices of these products will come down because again, they're not as expensive as human fund managers, but they're still probably too expensive for what they are, which is essentially another form of beta, a fancy beta. They're not plain beta, but they're kind of essentially something you can, if you can package it up in an ETF, and people are doing that, then I don't think you should be charging anything close to hedge fundy fees for it, essentially.
Right.
Yeah. At least some of the long only products like Avantis and Dimensional, they've got ETFs now that are a little bit more expensive than beta, but getting pretty close.
Yeah. I mean, we can kind of see, I mean, it's probably a digression, but like the price of beta is basically zero
Right.
for plain liquid large markets. And we're probably heading there for the smart beta products as
Yeah.
well. I think that's only fair. There are other ways to make money from these products. That will is they, and to be fair to them, like I mean, if you buy an ETF from BlackRock, that's like a value ETF. I mean, there's a little bit of tinkering iteration that goes, but generally speaking, they don't spend a lot of money and time on iterating the research constantly. But if you go to like a Dimensional, an AQR, a Panagora, these shops do spend quite a bit of time constantly changing things because they do know that the world changes. So a classic case is that like value. So obviously the way that we value companies is very sort of tilted. It has a bias towards companies that have big like factories. Like you look price to book. So if you have big hard assets that are worth lots of things on accounting value, they tend to look cheaper. But it means that companies that have hugely valuable IP aren't is treated as well. So, and I do know this. I know there were value investors, both human and systematic quant shops that had Apple as a value stock because really, if you adjusted for the insane amount of cash that it had on its books and the IP, you can very easily argue that Apple was a value stock through most of the noughties. Which just goes to show these classifications are a little bit arbitrary, and you'll see different things at different shops. But there is iteration, tinkering going on. For example, including intangibles in the value factor, for example, and that seems to be having improved things a little bit. And talk to these people, that standing still is falling backwards, and you have to run pretty fast to stay ahead of the market curve.
On a somewhat related topic, can you talk about what's going on with noisiness in factor data?
Yeah, I mean, this is like essentially, it's like everything in world. It looks great from a distance, but the closer and closer you look, the fuzzier it gets. The resolution just starts kind of breaking apart. And factors the same way that, when I talk about value, momentum, quality, size, all these things look great, but then literally fairly humdrum decisions about what time frame do you use or what size of stocks include. You include micro caps. Do you include Botswanese stocks, Chinese stocks, all these things, what you include or exclude, and time frames, literally from day to day, month to month, can have huge impact on what kind of results you show. Now, most serious quants know this and will be very honest about it. That, you know, like anything, our human attempts to impose an arbitrary, quantifiable, metrical system on something is always doomed to failure, especially when you kind of put it on something as chaotic as financial markets. But yeah, so there are people that say that a lot of the classic Farmer French factors that Eugene Farmer and Ken French have discovered, if you look at what Ken French has as his online library, just changing what timeframes you measure changes the results quite significantly. I think it's really interesting. And I think it's a reminder for me, it's just a reminder that you need to take all this data, even when it comes with, incredible scientific rigor by the finest academic or practitioner minds in the industry, take it with a fistful of salt. This is not physics. This is, an attempt to put a framework onto something very messy. So I've seen some people say, oh, this is factors, that the whole noisy factors papers show that factors don't work. And other people say it means nothing. And well, it doesn't mean nothing. It just is another reminder that we need to be careful about treating any things like this like gospel, is my view.
Just to put a cap on this, where do you think factor investing goes from here?
Well, I mean, it'll get cheaper. It'll get better. It'll have bad periods. And I think it's been interesting to see that the money has not really come back as far as I can see. It stopped bleeding out. The multi-factor quant industry stopped bleeding. But the money hasn't come back. And it'd be interesting to see after, AQR has had some phenomenal years, but I think most people have had pretty good years, whether that starts coming back. And again, I think because of that algorithm aversion issue I talked about, it'll probably be pretty slow. But that's a good thing for the performance. If it was a fundamental issue that this stuff just got overmined and overused, maybe that is a good thing. That the longer people stay away, the greater the pain, the greater the premiums for the people that either stuck to it or go in opportunistically. But I think, you'll have another hype cycle, maybe caused by financial journalists like me. But I hope that people remember this as an example that, there is no free lunch. You can't just say, oh, small stocks have done really well over the past century, so ergo, they're definitely going to outperform big stocks over the next century, because lo and behold, there is no law of science that says it is so. The classic case of this was Paul Samuelson. And we talk about like in the long run, stocks always do well. Well, not if you're investing in stocks in Russia in 1914 or 15. Those stocks went to zero.
Right.
So I think we need to be humble about what we know about these things. But, as a balance, as a component of a portfolio, I mean, some of these things do well when everything else stinks. It's really interesting that, for example, that a lot of AQR's more hedge fundy strategies, at least, did really well in 2022 when everything else stunk out of the place. So they would say this shows that you should have, not all your money in AQR strategies, even they wouldn't say that. But should you have some of your money in some of these strategies that, yes, can kind of lag behind the broader market when everything is going well. But when things like 2022 happen, they tend to do less badly or maybe even well if it's a more sort of hedge fund strategies. That makes sense to me, but I think, if you're a sovereign wealth fund, you can look at these things a little bit more holistically. If you're an ordinary investor, I'm levered long Norwegian property and in index funds, and I quite like not having to think about it from year to year at all.
Yeah. Tracking error is really hard for people.
Yeah, I mean, just literally, people will say that you'll look at 5 different value ETFs, and they'll perform radically different, right?
Yeah.
Talk to them, so why is that? Well, subtle differences, and yeah, it's just kind of messy, right?
Yeah.
So, and this is why, frankly, even something like, I mean, if you talk to like Bill Sharp about this, who the guy who invented the term beta, he absolutely hates the term smart beta because it implies that normal beta is dumb and this is smart, and it really isn't. It's just marketing, and to be, since I've been somewhat nice at AQR, I can say that one thing that AQR is really good at is marketing. They've marketed this. I mean, it's partially like the Cliff Asness brand. He's a brilliant guy, but they
Yes.
put a lot of paper that, I mean, to their credit, fantastically transparent, including when things go badly. And frankly, as a financial journalist, I can tell you it's very rare that people talk about stuff when things go badly. And I'd say Asness and the AQR crew actually were better in talk about this and picking out the scabs of their wounds when things were bad than most people are when things are good, doing well, to the credit. But it's marketing, right? And I think, should you put all your money in a value ETF or a value strategy or even a multi-factor quant fund? I'd struggle with that. But you know, we all some people like Manchester United, some people like Liverpool. Only one right answer in football. Everything else, the answer.
Good answer.
Speaking of things that are maybe not doing so well, what do you think about all the hype around private credit?
Yeah, I mean, it's fascinating. I wrote, again, one of those things that I didn't time the top. I wrote that private credit was just like just an incredible bubble 5 years ago, I think. It was when I started getting cold calls in the United States when I lived there. People were literally trying to sell me like a corporate credit line. And, it won't shock you to know that journalists and journalism is not very creditworthy. So this, like, if they are cold calling to try and generate supply, there is way too much demand out there. But lo and behold, it's just gone even more nuts since then, right? I'm getting now like cold like pings on LinkedIn for people that asking me if I would need any credit. And given everything else we can see going on in the credit world, that's pretty wild to me. Against that, look, I think it seems bubbly. I mean, I've written about something called the email index indicator, like how much emails I get. Whatever I get the most emails about is usually the most spurious bullshit
Yeah.
going on in the markets at any given time. For a long time, obviously, it was anything crypto. It was kind of wild. I mean, crypto is still annoyingly persistent in my inbox. ESG was pretty high for a period. Um, AI recently, definitely a big email index, amber light flashing. But private credit is frankly the worst one. I can literally write columns saying this is stupid, and people will say, "Oh, you should write about my private credit strategy." So against that, and it sounds very negative because I think it is kind of crazy. There's definitely some pain already happening now because private credit is floating rate. So as interest rates have gone up, it's increased the pain. That's why the returns probably look okay so far because it's not like fixed income that goes down in value when interest rates goes up. Private credit yields better when interest rates go up to a point when that company is basically just blown apart. If you borrowed at 500 basis points, 5% above LIBOR, it was LIBOR 5 years ago. Today, you're paying 10%, right?
Hmm.
A lot of these companies are not going to be able to stomach that. And a lot of these companies are not very asset rich. So private credit funds will say that we do lots of credit work, we have bespoke loan docs and all sorts of things, which I completely agree on, and they do work with these things. But the docs won't help you if this company just goes belly over. Um, and that is already starting, and it's probably going to get quite gruesome. And there's still too much money chasing too little. That said, I think the broader trend is really cool and kind of interesting. There's, I actually think that more lending should be done by the markets. And that doesn't mean that like that is um, a million times better. Like essentially, a loan is risk, and risk, as the saying goes, it's like energy. You can't destroy it; it just changes its form. But actually, I would rather that risk of that corporate loan being in the market or an investment fund, an unlevered usually or modestly levered investment fund, than in a bank that even after 2008 is still heavily levered and is holding my deposits essentially. I want that risk in the markets, in the capital markets. And private credit, the bond market is really good at big chunky stuff. Like if you're IBM, you don't give a crap about private credit. You can issue $10 billion tomorrow, no problem. The bond market, even after Lehman Brothers went bust, IBM and some of these other big companies, is almost as a sign of faith and to show that they did issue 10-year bonds. And they paid 5, 6, 7, 8%, incredible prices, but they could do it even weeks after Lehman went belly up. But smaller companies have a lot harder time, right? Because banks can't or they won't lend as much to them. So can, in theory, private credit fill that void? I mean, that's what we kind of see so far. I think a lot of the talk of this is mostly, again, marketing. In reality, if you look at the private credit world as it exists today, it seems overwhelmingly to be private credit funds scratching the backs of private equity funds. It's overwhelmingly supplanting leverage loans and high yield bonds as a component in the broader leverage finance machine. So it's basically just helping other private equity funds. They're lending to each other's deals. That's fine if sometimes a little bit iffy, but in an ideal world, this phenomenon would go through a credit cycle or two, and maybe it might evolve into something that is genuinely a new valuable addition to the financial system, especially in the United States, where smaller companies that don't need to borrow because the bond market won't take, a $50 million bond anymore. They want 200 million at least, ideally, so $500 million at a time. They want the liquidity. But if people are willing to accept the liquidity of private credit, suddenly you're opening up a lot of companies that normally can't go to the bond market and might be disenfranchised by the big banks can suddenly have raised capital. And that'd be, I think, a positive thing. So, yeah, that's a very long answer to say I think it's an incredible bubble, but out of bubbles, sometimes positive things do emerge.
That is true. The theoretical future state, I agree, does sound interesting. As it exists now, though, who do you think stands to benefit most from private credit?
Well, the private credit funds, I mean, these are incredibly fee-rich products. And some of the asset management, you can see there's a reason why like a Blackstone is worth, more than Goldman Sachs now. It's worth more than BlackRock, even. The rest of it is, almost 10 times the assets because these are very expensive products. But, and the saying in the industry, there will be differentiation. The one thing that scares me as a journalist, when I've talked to people in this world, is that most of them will say, look, yes, things are going crazy. People are doing dumb things and you'll come back to haunt them. But we're not doing dumb things. It's everybody else. But that's what everybody's saying, right?
Naturally.
Everybody's saying that everybody else is doing dumb, but we are remaining super disciplined, conservative. And this is when real credit work, due diligence, legal finessing, that will really make the difference. We will differentiate ourselves. And I'm sure some of them will, but I have no clue who it will be. But there are some of the bigger firms that you can see have more experience with these things. But there'll be some accidents. The problem is for a journal like me is we won't see them. I mean, these are private credits. It's really annoying trying to find out, even when there's extending and pretending going on, which I gather there is a lot of, finding those concrete, juicy examples you can splash on the front page of the FT is just very hard. So, if you're a kind of rubbernecker like me, you like looking at accidents, financial accidents. The problem with private markets is that they happen mostly in the shadows.
Yeah. Yep. Yeah. I agree with all that. I also agree with the email index. This is the one that's like you said, it's crazy how many inbound emails I get, and how I went to a couple of conferences last year, and the number of times I was approached to look at this. You got to look at our private credit fund. It's like, man, how many of these things are there?
Yeah,
Crazy.
it's incredible. And I don't know. I mean, I think people know it's kind of crazy, which it makes me almost wonder, well, why are you still pushing this? And the only example I can think of was, look, private credit is a legit asset class that I actually hope will grow and become more important because I think it has potentially a huge role to play. But it reminds me a little bit about the worst of the crypto excesses. Like that's like I won't probably shock you by saying I'm not a big believer in magic beans. And yeah, you know, I once wrote a column saying that crypto was like an Albanian Ponzi scheme because there's some really fascinating parallels between just this massive outbreak of Ponzi schemes in Albania after the fall of the Iron Wall, the Iron Curtain, and that basically just kind of ruined the country. It caused a civil war. It's just incredibly dramatic. But how something that was entirely outside the financial system kind of wormed its way in and caused carnage, wrecked political accountability at a very sensitive time, and just caused damage. And this was quite incendiary, me writing this. I still got like 100 emails saying, "Oh, you should write about my coin because my coin is super good, and
Wow.
this is really good, and my blockchain project is the best in the world. It's going to revolutionize whatever." And it's like people don't even read what you're writing; they just read that you're writing about it. Oh, you should get in touch. Private credit has been a little bit like that. Even when I write mean things, people tend to say, "Oh, you should talk to my people about this," which is good. I do want to talk to these people about it. But yeah, it's going to be fascinating to see how it plays out. The only worry I have is that I like to be publicly proven right, and maybe with private credit, we'll really only know in 5 years' time when we've seen the actual investment returns, the net IRRs of some of these funds when they start trickling out from institutional investors.
Speaking of fascinating, can you share with our audience what you're working on now?
Well, I mean, for the people who can see me, I've got a very rustic background because I've locked my way myself into a wood log cabin outside Oslo. We don't have running water, but it's because I can spend just solid amount of time working on a book on the history of the bond market. So I'm
Oh,
a bit of a history buff. I love history, and I like, especially when you can use sort of an unlikely hero to tell a wider story about how the world is the way it is. So my first book was about index funds and really tried to write about like the evolution of investment management and markets over 100 years. But look, I love bonds. It was my first job as a financial journalist was covering the bond market. And as Cat Stevens sang, the first cut is the deepest. So I'm now writing a sort of 1,000-year history of the bond market and how it shaped the world that we live in today and how it's going to continue to shape it. Because for the first time in history, bonds are actually half of all global credit. So for the first time, they've beaten back bank loans since they both basically emerged in Renaissance Italy 1,000 years ago almost. So yeah, that's why I'm going unshaven and unshowered for a few days to break the back of that project.
well, we look forward to that book, and if it's as good as Trillions, which we absolutely loved and our audience loved it, it'll be a great read. So for sure, we'll have you back when that comes out. Robin, great to see you.
No, thanks so much for having me on.
Thanks, Robin. All right, Mark McGrath, welcome back to the Rational. Do I even say welcome anymore? You're kind of just a fixture. I don't know.
I know. Well, it's been a while.
Good to see you.
Well, thank
Mark.
you. Thank you. It's good to see you guys as well. Yeah, I think it's been, we were just talking about this. It's been almost 8 weeks. I was away for a long time over the holidays in Mexico visiting in-laws. So it's been a while since we've done one of these.
Plus, our schedule's been kind of off so far this year with guests and whatnot. So we're kind of getting back to the normal groove now.
Good. Yeah.
So
Well, hopefully
what
we'll
you
make it more regular. Yeah. So what do I have? So I'm going to talk about the Canadian Pension Plan today, CPP. I'm going to try not to get too far into the weeds on this. It's an incredibly complex topic. There's a ton of math involved. I don't want to get too deep into that. I'll explain it still, like at a high level, but I think what I want to get into is why I think at least CPP is a huge benefit for many, many Canadians, and maybe just talk about some of the common criticisms that I hear from opponents of it and address those. So I posted something on Twitter the other day about CPP, and it got quite a bit of traction and tons of comments. And there's a lot of comments in there about how it's theft and the government's stealing our money, and you should just be able to opt out of CPP for some if they choose to, and invest the money themselves however they want, and all these things. And I just don't agree with that take, and I'm going to explain why in a minute. And Ben, I know you've been thinking a lot about CPP lately, so if you have anything to add or to correct me on, by all means, just jump in. So CPP, yeah, so it started in the mid-'60s. I think it was 1966, and it was primarily designed to...
Great year, by the way.
Is it?
66 is a phenomenal year. Some of the greatest people were born that year.
That's good to know.
I'll throw it out there.
Yeah. So it was started in 66, and it was primarily to address the economic instability of retirees. I think OAS had been around for a long, long time by then, but that was kind of intended to be just a Band-Aid solution until something more structured could come along, and so CPP was launched. And the way it's designed is it's designed to replace 25% of your earnings up to certain earnings limits, right? So, and there's an enhancement that's just come out, and we'll chat a bit about that as well, but what they call the YMPE, the year's maximum pensionable earnings, is a number that's set every year, and it's indexed to inflation. And so your income up to that level is intended to be replaced at a 25% replacement rate by CPP. So it's not meant to fund your entire retirement. It's significantly lower than Social Security in the U.S., for example, but it's a staple.
Can I add something real quick?
Yeah.
The YMPE is not necessarily indexed to CPI.
Right.
The yearly maximum pensionable earnings is based on wages, which they historically at least have not grown in lockstep with inflation. So, like you said, I have been looking at this recently. Going back to 1990, the yearly maximum pensionable earnings has grown about 50 basis points annualized faster than CPI. And that actually has some really interesting implications for if you look at like the internal rate of return, or like how good of a deal is CPP. The fact that the benefit grows with the YMPE is it's additive to how interesting CPP is. Once you start taking the benefit, it's indexed to CPI, but your contributions
really interesting,
and your starting like when you start taking CPP in the first year is all based on YMPE. So when you talk about like the 25% replacement rate, that's based on YMPE, and so it changes at a rate slightly different from price inflation.
From CPI. Oh, that's interesting. Okay. Yeah, I knew that it was indexed to wage inflation, but I didn't know what historically what the difference was in the actual rates between the two. So that's really fascinating. Right. So it's a contributory plan. So you have to contribute now 5.95% of your earnings between $3,500. So that first $3,500 a year that you earn is exempt from CPP contributions, and then up to that first ceiling, which now is I think $68,500. So you contribute 5.95% of your earnings within that band, and it works out to about $3,860 I think right now. And of course that'll increase over time. If you're self-employed, you make both contributions. So employers also have to make the same contributions at the same rate, that 5.95%. If you're self-employed, it feels like you're making double the contribution, right? Because you're seeing that coming out of kind of as a payroll tax. I'd argue that regardless, like for every Canadian, that 11.9% is being contributed, right? So if I'm an employee, like I am at PWL is contributing that 5.95% on my behalf, and it forms part of my total compensation. And this is actually a question I had for you, Cameron, because I got a lot of pushback from business owners saying, well, no, I have to make double the contributions. And my rebuttal to that has always been, well, no, your total compensation as an employee reflects all the benefits that you get and any pensions you have, as well as CPP contributions. So Cameron, when you think about compensation for employees, presumably you factor in that there's a cost of the CPP, total cost, right?
We call it DAS, deductions at source. We include that whole envelope in compensation at a high level. Absolutely have to, because there's also health tax that you pay and other things you have to pay for sure.
Exactly.
The idea that business owners pay double into CPP is always something that drives me crazy, because it just in equilibrium thinking, that money didn't come out of nowhere. It came out of, there's actually, I found one empirical paper on this that asked that question, like who bears the cost of social benefits? And I don't remember the specific details, but it varied by country. And it was something like, I don't know, around 90%, I think, of social benefit costs are borne by employees, like out of what wages they would have otherwise earned.
Yeah, exactly. Because presumably if the employer didn't have to contribute to CPP, then they'd have additional cash left over for compensation in other ways, right? And it would sort of equalize in some sense. So that's how I think about it. I totally get the feeling that you're doubling the contribution, that you have to pay more, but I just don't think that's true in practice if you frame it that way. Right, so you contribute, and they calculate your contributory period as the ages between 18 and when you take the pension, which is traditionally at 65, but you can delay it, you can take it early. So from 18 until you take that pension, that's your contributory period. And they drop out certain years from it to kind of make it a little bit easier on you. So they drop out 17% of your lowest income years. There's additional dropouts for those who had lower income to raise children, up to 7 years per child. And then there's a disability dropout provision as well. So if you were on the CPP disability, if you qualified for the CPP disability benefits, those years are also dropped out from the calculation. So the way this all comes out is your actual contributory years between 18 and let's say 65 are 39 or lower. So 39 because you drop out 8 years as the general dropout, that's 17%. And if you raised kids or were on disability, then your total contribution period is less. So at a high level, that's how it works. You can take it at 65. If you take it early, there's a penalty of, I think, 0.6% per month to take it early, if I'm not mistaken. And if you delay it, there's a benefit of 0.7% per month. Yep. So there's an incentive there to take it at 65 or later. And because it's indexed to CPI, by delaying it past 65, you get that higher starting base, and then it compounds at a rate of CPI. So usually, if you're projecting a long enough lifespan, then delaying it usually can make sense mathematically, but we don't know. So that's generally how it works. The payments that you get right now, I think the maximum CPP payment is $13.64 per month. So it's, as some commenter said, like, it's not even enough to pay my rent. I was like, well, that's true, but imagine if you didn't have it, it'd be a lot harder to pay your rent if you didn't have that money coming in, right?
Thank you.
It's real money. It's not. Oh, it's real money, yeah. And like we've all dealt with retirees. Like I've never met a retiree who didn't love their CPP, right? It's that steady inflation-adjusted income. It takes reliance off of other sources of risky assets like a portfolio. And when markets are down, they know they're getting that steady income check. And all the risk has been transferred to CPP. And in my experience, retirees love it, right?
Yes.
So now for business owners, you only contribute to CPP if you've paid yourself a salary. And I was actually talking to two accountants the other day about this, and they had a client exclusively on a dividend compensation model. So if you're a business owner and you have a corporation, you can compensate yourself by paying yourself a salary or by paying yourself dividends. And if you pay dividends, it's considered investment income, right? There's no CPP deduction for dividends. So what a lot of accountants, in my experience, will recommend is you just pay dividends, and then that way you don't have to contribute to CPP. You save that money instead and do something else with it, right? And there's a lot of downside to that in my experience. The one, you don't get CPP, and I just think CPP is great. So yeah, you don't get it. Two, a lot of people don't do a great job of taking those savings and actually investing them appropriately over long periods of time and actually compounding that savings into a sum that would be greater than what they would receive by CPP over the long run. And I think for me, the biggest one is you get no RSP room if you do that. So if you only pay dividends, there's no RSP room given to you. You have to pay salary to get that. And so what often ends up happening is you have corporations that don't have, you don't have individuals that can contribute to an RSP and they haven't contributed to CPP, and you end up with what I consider is a bit of a concentration risk, right? You end up with too much in the corporation and not enough diversification of other sources of retirement income like RSP income and CPP. So I'm a big fan of it from that perspective. But I think the biggest thing that I realized while I was reading about this over the past couple of days is that this concept of being able to opt out and save the money and invest it yourself, I think is a very dangerous suggestion. Like I'm sure there's people out there who could just absolutely nail this and do it properly, and they would be way better ahead. But in looking at some stats from StatsCan and a couple of surveys over the past couple of days, Canadians are not doing a great job on average of preparing for retirement themselves. And CPP as a form of forced savings, for a lot of people, it's going to save them. So I just want to talk about some of these stats, which kind of blew my mind. StatsCan said that the average Canadian saves 6% of their disposable income per year. So that's after-tax disposable income. They're only saving 6%.
6 of that.
Yeah, and that's from Stats Canada. So that's a very, very low savings rate. So people are already, and the argument can be made, well, we can't save as much because we have to make these CPP contributions. Sure, but on average, people are not saving a lot as it is. there was actually a study that came out today from the National Institute of Aging, and it said only 33% of Canadians over the age of 50 say that their income is high enough to let them save at all. So over 50, only a third say their income is high enough to let them save. So people are not doing a great job of saving. And this is, to be clear, I'm not blaming anybody. I get it. Life is expensive. Housing costs here are expensive. Maybe wages aren't as high as you'd like them to be. But the reality is people have trouble saving for a variety of reasons. And 70% of that same age group, Canadians over 50, said that they are afraid of running out of money in retirement. So these are big numbers, right? Mm-hmm. CPP works in favor of people who are in those situations, right? It's a guaranteed indexed pension for life. Doesn't matter if you live to be 120 years old, that money is going to keep coming in. And if Canadians have trouble saving already, this forced savings program, to me, is going to save a lot of people. A couple more interesting stats. Deloitte did a survey and found that only 14% of near retirees are expected to be comfortable in retirement. 14%. So the rest are expecting a drop in their lifestyle of varying degrees when they retire. So very few people are going to be able to continue the same lifestyle in retirement as they've become accustomed to during their working years. Another stat was, this one was interesting. I found this today. There's a lot of reasons for this, I'm sure, but the median net worth of a family that has an employer-sponsored pension, so we're not talking CPP, this is your classic like defined benefit plan from an employer, but the median net worth of families that have a defined benefit plan was 7 times higher than families that don't have one. Now, there's some causation correlation issues there, I'm sure, as well, right? Like maybe higher income jobs have better benefits and more pensions, but I thought it was a very interesting stat.
That's basically counting the present value of that pension, I guess, the commuted value, perhaps?
Yes, exactly. So I think the point there being that those who don't have a pension, all things held equal, exactly, are not doing a good job. Because so much of this is behavioral, and we know from talking to clients and people all the time about money that people have a tough time saving adequately. And these stats, I think, bear that out, right? So with all that in mind, I think CPP is a great thing. I think, yes, there's absolutely some people who would do better on their own by not having to contribute. I saw a lot of comments saying, well, the government should put it in an account where you get to control the investment options. And I just know enough people who just blow that up entirely by buying all sorts of irrational stuff. So you'd have to put very serious restrictions, I think, on the investment options that are available. But yeah, the enhanced CPP, the new contribution plan, is going to, after 40 years, the maximum CPP benefit is going to go up by over 50%. And so I think that's very meaningful. You won't get that benefit until the year 2065 or later because it's being phased in over 40 years. But the improvements to the plan are going to replace up to 33% of earnings instead of 25%. And I just think that's great. So I think that's it. I mean, at the end of the day, it's a very controversial topic. It's a very complex topic. I think Canadians aren't doing a great job for a variety of reasons, not necessarily their own fault, but they're having trouble saving for retirement. CPP acts as a very good filler for maintaining a certain basic minimum level of indexed retirement income.
And that that enhancement is, so the base CPP is 4.95% of your earnings on both the employer and employee sides. And then there's the initial enhancement, which is the extra 1%. Mm-hmm. So like you mentioned earlier, the contribution is 5.95%. Some of that is base CPP, some of that is the additional CPP. And then now there's another additional CPP. There's another contribution ceiling, which is this year, 2024, 7% above the yearly maximum pensionable earnings. And then in 2025, when it's fully phased in, it'll be 14% above the YMPE. Yep. And so we're making now 4% on both sides. So 8% total.
That's right.
Of the additional, the additional ceiling to get to that 33% replacement rate.
Yeah, that's exactly right. So the 5.95% contribution goes up to that first ceiling, and then there's a second range, a second ceiling, and income between that range, you're contributing 4% instead of 5.95%. That's primarily how they're able to increase the benefit to 33% in the future, right? Yep.
Yeah. Yeah, there's tons of interesting stuff in there too. Our friend and fellow advisor Aravind has done a bunch of work on this, and I'm working on something with him on it now. That the base CPP results in a tax credit, which reduces tax at the lowest marginal tax rate, and then the enhanced CPP or the additional CPP results in tax deductions, and so that makes the cost of CPP of additional CPP lower for people in higher marginal tax brackets because it's a deduction rather than a credit. Anyway, so there's a really interesting curve of the total cost of contributing to CPP depending on what your income is, and then likewise for the employer side and the corporation, the cost of CPP also depends on what your corporate tax rate is, whether you're a small business or not. So, like you said earlier, Mark, there's so many different layers of nuance and complexity to CPP, and I agree. I think that based on the work that I'm doing right now, even from the perspective of investment returns, like is this a good investment? I think depending on how long you live, it can look very, very attractive from the perspective of IRRs, from internal rate of return, but also it's the only way to get an inflation indexed annuity in Canada. You can buy an annuity and purchase indexing at a fixed rate. So you can buy an indexed annuity at 2%, which you pay a lot for, and you get a 2% increase to your annual annuity payments. But that's not inflation indexing. If inflation's 8%, your 2% indexing doesn't save you, whereas CPP is indexed to CPI. So if we get runaway inflation, which is like the biggest risk for retirees, CPP is designed to keep pace with that, and you just can't get that asset elsewhere. Like CPP is the theoretical risk-free asset, and you cannot get it anywhere else. So why anybody would avoid paying into it is just beyond me.
Totally. And I think most opponents of it, they complain about the return that they get on the contributions, right? But the return is not calculable until after you've died. You have no idea what the return is going to be because you don't know how long you're going to live. There's also disability benefits. There's child benefits too for if a CPP contributor passes away and has a child under the age of 18 or 18 to 25 if they're at university. There's benefits there. There's a small death benefit. There's a survivor benefit as well. So you can pass part of that CPP onto a surviving spouse. So the IRR calculations just are so difficult because the variables are so far out in the future for most people, and you just don't know what path it's going to take, right? And to your point, Ben, I just think it's not even an apples-to-apples comparison to compare something like CPP to an investment portfolio that has risky assets, volatile returns, sequence of returns risk, variable withdrawals. Like, it's just not the same animal at all.
Cognitive overhead.
Yeah, totally. Yeah, 100%. But the happiest client I ever had, so just quickly, Ben, I think I probably told you guys this story. I might have even told it on another episode. The happiest client I ever had did have an indexed pension, and he had nothing else. And this was a private pension. But he was in his 80s when I started working with him. And at that point, his monthly pension was over $8,000 a month. And he had zero portfolio assets. And he just had that and his house. And he was the happiest client I ever had in my entire history as being an advisor, because he just didn't care about anything at all, because that income was coming in and he was just happy as a clam, didn't care about the markets, volatility, risk, headline news, none of that stuff. Just got his pension, got an index, and loved it. Totally. Yeah.
Yep. Yeah. So I think CPP is incredible for all those same reasons. And you mentioned how long you don't know what your rate of return is going to be until you die, which is true. But the other piece that matters is what inflation experience is over your lifetime. Because if you live long and inflation is high, it's like, wow, CPP is the best. The other thing, and we got this from when Scott Cederberg has been on Rash Reminder, and when we've talked about his work, domestic stocks don't do well when domestic inflation is high. International stocks give you a little bit of protection against domestic inflation, but like, again, CPP is a risk-free asset in real terms. If you get high domestic inflation and you have a Canadian home bias, like most Canadians do in their portfolios, Canadian stocks probably aren't going to do great over that period. Whereas your Canada Pension Plan benefit, assuming the government stays solvent, and even beyond that, CPP is an independent, the assets are managed by an independent body. So it's like, I don't know. I just don't know. I don't understand why anybody would be opposed to having that asset.
Yeah, well, you're right. It's I guess inversely correlated in that sense, or negatively correlated when inflation's high to domestic stocks, right? And so you've got this other asset that's actually increasing in value as your monthly payments go up while stocks go down.
Exactly.
And I think the other thing that people don't like about it is the death benefit is very small. I think it's $2,500. Right. And I totally get that, right? Like people are saying, I paid into it my whole life, and if I die at 64, my heirs get nothing. And that's true, but I mean, the actuaries know that. Like the CPP math is based on exactly that. And if you wanted some sort of additional death benefit, the contributions would have to go up so significantly that I think there'd be no appetite for it anyway, right? So
you mentioned Arvin, Ben, earlier. We should give a shout out to the podcast episode that he did with our mutual friend Jason Pereira called The True Cause of CPP. That was on Jason's podcast, Financial Planning for Canadian Business Owners. It came out last week. Good episode. If someone wants to dig into the real details, and they get pretty passionate about the math on this, of course, knowing those guys.
Yeah. The reason that I've been digging into this is that we're doing an episode on, for Money Scope, we're doing an episode on how to compensate yourself from your corporation. And so, of course, CPP is a big part of that because it plays into the decision on whether you should take salary or dividends. So I've been talking to Ervin a lot, and then I've been modeling that decision. So do you pay yourself a salary and pay into CPP, or do you pay yourself a dividend, which lets you leave some money in your corporation? Because instead of paying into CPP, you've got this extra bit of money left over, which some people view as a tax, but as we've just talked about, it's not. You're paying into a valuable pension. So if you compare taking a salary and paying into CPP to paying yourself dividends and leaving a little bit in the corporation and investing that, how do those things compare? And so far, preliminary findings, CPP looks very attractive for a business owner relative to keeping money in the corporation to invest.
That's interesting. That's going to come out in the paper that you're working on with
That's
Ervin?
what the paper that we're going to work on is going to be.
Awesome. I look forward to that. And Ervin loves CPP, so if listeners know him, reach out to him on Twitter or LinkedIn. He'll talk your face off about CPP all day long.
Ervin just loves people.
That's true. Yeah, reach out to him about anything.
Just reach out anything. Doesn't matter the topic. Ervin just loves people.
That's true. Cool. I'm sure we could keep going. Like I said, it's a complex topic, but I think maybe we leave it there for today. And if listeners have questions or want to reach out to me, they can find me on Twitter or look me up, and happy to chat about it as well.
Love it.
Great to see you. Great topic.
Thanks,
awesome.
Mark.
Likewise. Okay, guys. See you soon.
Great to have Mark back on. I thought that was a great conversation. I really like when we just kind of riff on cool stuff and to hear stuff you're working on and whatnot. But I think that conversation does link to one of our earlier guests on the podcast. And I remember the day I was actually in New York City, and you had texted me saying, we're just kind of getting in the rhythm of getting guests on the show. And I remember you saying to me, okay, who are we going to get for a guest next? And I just, for some reason, thought of Alexandra Macqueen. So she joined us on episode 59. And Alexandra's a terrific professional in our space and very serious person as well in our space. And she's currently the Vice President of Learning, Development, and Professional Practice and head of the FP Canada Institute at FP Canada, which is very cool. I knew her from the book Pensionize Your Nest Egg, which she wrote with another past guest, Professor Moshe Malevsky. He was on with us, episode 122. And just thinking about that book inspired me to reach out, so she agreed to come on early. So the episode was called Financial Economics and Annuities, Rational Planning for Retirement. And it was a fantastic episode about annuities. We talked about the distinction between financial economics and financial planning. Financial economics being a branch of finance that is about the efficient and rational use of resources and conditions of uncertainty. And Alexandra highlighted that while this might sound like financial planning, planning is not advanced to this level of an academic discipline yet. And this goes to the root of any discussion that you can have about annuities. While it might be sensible and rational, and we talked at length about this, and you and I live this often with clients, often it's very hard to actually get people to implement, from a behavioral standpoint, an annuity. And for all kinds of reasons, and Alexandra talked about the rules of thumb in our industry that often discourage people from doing or implementing things like annuities. She talked a lot about product allocation and how that's different from asset allocation, annuities can be a very important product to consider in retirement income planning. They're very efficient, they're very cheap, and in Canada, the popular one is the single premium income annuity. It's worth noting that a simple annuity in Canada is very different than the complex ones in the U.S., so she also highlighted that. So she went back to basics, explaining what an annuity is, how they work, and how they can really improve, to Mark's point earlier, how they can really improve your retirement income situation. And she also talks about, the profile of person that might be best suited for an annuity. So if you're interested at all in this or anywhere near retirement, and I would also highlight with higher interest rates now than there were 5 years ago when Alexandra was with us, I think it's worth checking out our conversation with Alexandra Macqueen back on episode 59, which I know, Ben, you remember that episode pretty well.
It's a good episode.
Cool. All right, let's go to the after show. We talked earlier about this lead flow. Is kind of cool how that's all been working out. It's been super fun to see people just kind of automatically just coming into our orbit, which is really fun to have that experience.
Yeah, it's been incredible to see.
Okay, so you got to give us an update. What's going on with the Money Scope? Like, you're up to 33,000 downloads already, 2,000 subscribers.
Well, this is all news to me. I knew we were over 2,000 subscribers. I didn't know how the total audio downloads. That's pretty good.
And it was ranked so well it's still ranked really well, still ranked above this podcast in the Apple rankings, which is cool to see. And you were number one for quite a while, you and Mark.
Yeah, it hung on for a long time. The top spot on investing, and it was up super high in business. It's still ranking well on the Apple podcast charts. I don't know, whatever that's worth. But
maybe you're going to be too humble to promote it. I'm going to promote it. I think it's fantastic. I think you and Mark, the chemistry is fantastic. It is a financial literacy course that is so beautifully done, like building blocks. Like the way it compounds at such a nice rate of being straightforward but in depth on topics, and you're not rushing. You give it the proper amount of time. And I know you guys are reading notes, but you can't tell. It's really good. So if anyone out there is interested in going through a systematic financial literacy course, I highly recommend you check it out. Speaking of checking things out, for the month of January, we made available with our friends at Dimensional the Errol Morris movie, Tune Out the Noise. That site was visited 17,000 times. The movie was watched over 6,000 times, which I didn't know what to expect, but I think it kind of blew away people's expectations, which is pretty cool.
Yeah.
Speaking of movies, you and I talked about Griselda Blanco. You notice that link, that segue between? Anyone who hasn't seen it yet? It's six episode series on Netflix. It's wild.
Yeah, we haven't finished watching it, but I watched the first 3 episodes, I think. But I kind of know her. I don't know if I listened to a podcast about it, or I knew who she was though before we started watching the show. So it's but yeah, that show's well done.
I was talking to Angelica, so she also recommended Cocaine Cowboys, and I also liked Queen of the South, which I don't know what platform it's on, but we're checking out. 5 degrees in Ottawa today, not helping your ski season.
Oh, yeah, okay. It's 1 degree where I am. Yeah, I haven't skied this year. My kids have
I thought
skied
you
a
went.
bunch of times. No, I've been taking the kids.
Oh, you take them.
It's a bit tricky right now because, like, 2 of our kids are on the lift. One of them is just now going the lift. So, like, the next time we go skiing, I will probably have to ski because the 5-year-old needs someone to go on the lift with her, and she doesn't want to go on the magic carpet anymore because she's tried the lift.
Yeah.
But then our youngest one is just on the magic carpet. So it's been hard for my wife and I to ourselves ski because we're kind of supervising all these different levels of skiing skill. But now that our 5-year-old is on the lift, I'll be able to ski next time and go with her if it gets cold enough. I don't know if the ski hill will be open right now, or it'll probably be pretty icy. I don't know. I haven't checked it out.
I haven't skied at all this winter either, but it's not been a great winter for it. I finished at your recommendation as well as Morgan House's recommendation. I finished this morning the book Fortune's Children, The Fall of the House of Vanderbilt. And I know you had talked about it very early on in the podcast. What a book. What a story. The wealth that they created early on and completely blew it. And this is a 600-page book. It is so interesting to see, and you follow along the family tree. You get to know the names, and then like it ends with the story of Gloria Vanderbilt, who is Anderson Cooper's mother. And so I kind of knew about the Anderson Cooper side of it, but I didn't know the story of the wealth. You just assume Vanderbilt, there's wealth. It's like, wow, not true by the time you got through the family tree. So I highly recommend that book if you're interested.
I listened to that on audiobook years ago. Like you said, we talked about it earlier on the podcast, and it's an incredible story. It's it really
the wealth they had in the late 1800s. It was unbelievable.
Yeah.
And now, like, you read all the mansions they had on Fifth Avenue, everything is gone. All that's left from then, and it's been renovated, it's Grand Central Station. All the cottages, everything else is changed and gone. Speaking of reading, you and I talked about this as well. I decided to chill a bit on reading, kind of with a little wacko last year, the number of books. You just realize that it's just like this cascading of waterfall of information. It becomes almost a cognitive burden to try to optimize what you can do with all this information. So I'm sticking with the 24 and 24, which is still, I think,
that's a lot of books.
Still a lot of books.
Shane Parrish talked about this. Shane Parrish's Farnham Street blog, I'm pretty sure it started out as him reading just like a ton of books and writing about them or summarizing them or whatever. And then he realized exactly what you just said, that like you can't read that many books and actually retain anything and actually change how you think. And so he started reading fewer books, but reading them more deliberately. And I think he has a blog post on the Farnham Street blog about like how to read a book in a way that you retain the information.
And then you also realize that, you read whatever 60 books, but it's probably, 6,000 books published last year. So you're still only ever scratching the surface.
Yeah.
And then when you start planning out the year and looking at who's coming on for guests and those books, like the 24 slots fill up pretty quick, and there's a few books I want to go back and reread, but it's just been like more chilled about it. Speaking of reading, the 24 and 24 reading challenge is on this year. So it's our third year doing this challenge. So if you want to register, go to rationalreminder.ca, and there's a tab at the top, 24 and 24, very easy to join. Set up your ReadWise account. You can see what other people are reading, and it'll track your books that you've read. And there's book reviews in there too that you can post and you can check out. So far, we have 121 people registered for this year's challenge. Already, there's been 80 active readers that have read 202 books. Get this, Ben, since the contest started with the 22 and 22, there's been 7,481 books read.
It's a lot of books.
It's a lot of books. Okay, you want to rip through some of these reviews?
Yeah. Wow. So, I mean, I guess because we haven't done an episode where we've had an after show for a while, there are a lot of new reviews. But as we have always done, we will read them.
As awkward as that is.
Remember, there was a time when we were going to stop reading them, and then we decided to just keep reading them. We've never gotten the feedback that people don't like hearing us read the reviews. We've never gotten the feedback that people like it either.
There's only 3 people here, so I think we're good.
3 people left listening? Yeah, you're right. That's a good point. Okay. Michael from Chicago says, best finance podcast available. This podcast is a masterclass in how to think about investing. But beyond that, it's a masterclass in how to apply the scientific method, how to learn from those who don't share your views, and how to clearly present technical information. Ben and Cameron are open-minded, polite, empathetic, willing to learn from those who don't share their views, and open to changing their views in the face of new evidence. It's an oasis of civility in today's polarized, hot-take social media culture. It's a very nice review.
We are polite, yes. Deeplo John from the States said, best personal finance podcast out there. Hey, Ben and Cameron, I've been a loyal listener since day one, and I've really admired the show's evolution over that time. The rigor and academic basis is crucial, but I've appreciated your open-minded approach to disparate sources and evolution of low-cost index funds, robust approach as a DIY investor. Recognize Ben's work on dividends. I still value dividends for the ability to grow a small portion over time through a DRIP. Would welcome your views on DRIPs for investors starting with small initial investments and holding for the long term.
You're no better off with a DRIP than you are with an asset that never paid the dividend in the first place. But you know what? If it's working for you, John, I think that is perfectly fine. You know, dividends are one of those things that they're super fun to argue about because people get so upset about it. But it doesn't really matter. Like if you want to have a dividend-focused portfolio, like, okay, so you've got maybe a value and a profitability tilt. Maybe you're a little bit less diversified than you could alternatively be. But like, if it's going to help you stick with the portfolio, I don't
love it. No problem.
Care.
Exactly.
People just get so upset. So it's like, it's always a fun topic to talk about. Anyway, I was actually looking around. I was looking at fund returns versus investor returns, which is a data point that you can get out of some of the software that I have. And I'm torn on whether I should say this or not because people are going to pile on it. But so the gap between we've talked about on past podcast episodes the return gap between investor returns and fund returns, right? The return gaps for dividend funds are tiny.
Yeah,
tiny
behavior.
So, like, if you want an argument for dividend investing, it is that it improves investor behavior. And
100%.
I should formalize that, but I don't know. It'd be really interesting research to show. For what purpose, I don't know. It'll encourage people to have suboptimal portfolios for behavioral reasons, I guess. Anyway, sorry, getting off track there. One more off track comment. There's only like 2 people left in the room at this point, so I feel like I can say whatever I want. We were having a conversation a while ago about someone that you had met someone and you had talked to them about how they had met someone else who they discovered was also a listener of our podcast. And then those 2 people bonded over the fact that they were both podcast listeners. And for some reason it's hard to comprehend the impact that us sitting here talking has on other people. It's something that I still struggle with. And people will tell me occasionally how impactful whatever podcast has been and stuff. And I always have trouble internalizing that and really grasping it. But that story that you told me about other people completely separate from us in another country connecting over us talking, I don't know, that just made the impact kind of hit.
Yeah, and they said they at their work they all listen to the podcast at work.
Yeah. I don't know, stuff like that's just because it's still just me and you sitting here talking on Zoom like we've been doing for anyway. Clint from the United States of America says that this is his favorite podcast. I started listening to Rash Reminder around 2 years ago and recently made my way through all the episodes to date. I've learned so much on topics ranging from personal finance and investing to finding and funding a good life. The Ben and Cameron only episodes are always interesting and insightful, but when they do bring on their A-list guests, especially appreciate the interviewing style they employ. They ask pointed, good questions rather than allow their guests to answer with little to no interruptions. Rash Reminder also inspired me to become a more avid reader through its reading challenges, along with their book summaries / recaps on the show. I look forward to the new episode each week. Keep up the good work.
Yeah, we've had some feedback lately that we should or have the opportunity to push back sometimes, or some follow-up questions that perhaps could have been better in their eyes. It's always a balancing act, and we never profess to be professional interviewers either.
You know what? We get that comment when someone disagrees with the guests or whatever view. I disagree with their view. You should have pushed back. Maybe I didn't disagree. How about that?
But it's also the questions are structured in such a way to help tell a story. So we try not to mix it up too much and kind of lose the flow of where the structure is intended to take us. So it's all quite deliberate.
I mean, we're talking about financial economics and psychology. Like, you could get into a mucky debate with anybody on anything that they say. There's no point.
8009 from the States, by far the best personal finance podcast. Ben and Cameron do an incredible job presenting research-based insights and frameworks in an approachable way. I've learned so much from listening to them over the last year and really love how they spotlight short summaries of past episodes to help listeners dig into their back catalog. The guests are terrific, and the discussions with listeners on their website is engaging and educational. Look forward to the next episode every week.
All right.
Man,
Scott from, what's that?
There's a lot of them.
Yeah, there's a lot. Well, a couple more. Scott from Elora, Ontario says, tuning out the noise. Cameron and Ben, thank you so much for the time, effort, and passion you put into all that you do. I just watched Tuning Out the Noise, and it reinforced again what I've learned from listening to the RR podcast. Providing a link for your listeners is very thoughtful. Thank you. For the time being, I'm going to stay true to VGROW across all my investment accounts. VGROW is a Canadian asset allocation ETF that's market cap weighted with a home country bias toward Canadian stocks. It's a Vanguard product.
Yep.
Just for listeners' context. I am intrigued about an all-equity portfolio like VEQT, which is VGROW's 80% stocks and VEQT is 100% stocks, both asset allocation ETFs, after a recent podcast, but I just can't let go of some bonds. That is fair enough, no problem. You should not feel like you have to be all stocks just because Scott Cederberg's research says that you should be. Although that research, man, that impacted a lot of people. I'm not saying that's a good thing or a bad thing, but it was. There's a whole thread in the Rational Minder community. Like, how did the Scott Cederberg episodes change your portfolio? Man, I didn't change my portfolio, but I was already all stocks, so I guess I didn't have much to change.
Babo Cho from the States, amazing podcast. As a Wall Street veteran and professor of finance, I find the episodes that explore recent scholarship to be interesting without being overly technical. In fact, it inspired me to launch my own podcast on what any educated person should know about markets to be a good citizen. Love your work, guys. Keep it up.
Nice. Simone Ferrero from Denmark, weekly companion in commute times. The Rational Minder is a great podcast to increase your financial knowledge regarding personal finance. While the topics are fairly complex to a complete beginner, Cameron and Ben do an amazing job at dissecting each topic with the help of their guests. In a world full of noise and continuous research of alphas, this podcast tackles reality with great humbleness without asking anything in exchange. Thanks for this amazing free resource. A European personal finance aficionado.
A bunch of consonants followed by gloss from Sweden said, not bad at all.
I remember seeing that review and I was like, you know what? That's nice. I'll take it. All right, last review. Amazing podcast. Could benefit from more female guests. Incredibly insightful and interesting discussion on a wide range of financial topics. I especially love the episode's focus on happiness and psychology overlap with money. My main feedback, which is especially obvious when listening to the year in review, is there are pretty limited female perspectives brought onto the show. Would be great to find a way to more consistently bring on female guests to round out the perspectives and insights. Yep, we noticed that too, but we noticed it too late.
Last year. We have a lot of female guests coming up, thankfully.
Yeah. I mean, I've been joking to my wife that I'm not convinced that 2023 actually happened. It just flew by so fast.
Yeah.
I don't know.
Everything's flying by fast.
Yeah. But anyway, we heard that feedback in the Rational Minder community too. And we have been more deliberate in the guests that we've booked this year to get more female perspectives. I think that's valuable feedback, and it's definitely something we're going to take into account.
Yeah. We also discovered this week that this podcast is in the top half of 1% of 3.2 million podcasts based on what's called the Listen Score, which is, as we understand it, to be a metric that shows the estimated popularity of the podcast compared to other RSS-based public podcasts. So I don't know what goes into that algorithm, but it's more than just downloads. So that's kind of cool. But the median podcast, if I remember correctly, has 32 downloads in the period after launch. I think it's like a month after. So the vast majority of podcasts do not have a lot of downloads. So I think it's an extreme skewed data set. Had a cool conversation last week with a listener, Gavin, who is going to be a future member of our community, our industry. And so he was speaking with another listener, and that person encouraged him just to reach out to talk about our industry and career paths. So it was super fun to talk to him. And also heard from Evan, who is in our industry here in Canada, and reached out on LinkedIn to say he loved watching the Retirement Gurus 2 weeks ago, who were so good.
Yeah, that was a good episode.
And up next week, many listeners will be familiar with Bridgewater Associates and its founder, Ray Dalio. So this story is written up in a book by Rob Copeland called The Fund, Ray Dalio, Bridgewater Associates, and the Unraveling of a Wall Street Legend. Pretty incredible conversation about a pretty incredible company and personality.
Yeah, some really interesting perspectives that I mean, it's new information, I think, at least from what was previously publicly available about Dalio and Bridgewater. It was an interesting conversation.
In 2 weeks, we're joined by two experts in the ETF arena, Dave Nottig, who was here in the past, as well as Eric Balchunas from Bloomberg. They're going to be here to talk about ETFs in general, but also specifically about the recent launch of the new spot Bitcoin ETFs, which have been a blockbuster success from what I can tell so far in the first few weeks of being available. And in 3 weeks, special guest coming on, the man behind the 10% Happier movement, Dan Harris, will be here. So we did a book review of 10% Happier a few years ago, and there's also the app, but Dan has agreed to come on, which is very cool. Anything else, Ben, you want to highlight before we bring this in for a landing?
No, I think we can bring it in. I see in your notes that we're getting vests in the store. Is that real?
Apparently, as Angelica says, we're woefully low on merchandise. So if you check out in the store, there's a lot of sizes not available. There's still some stuff there. And I know Jackie is topping up every order with like the bucket hat and socks. So if you make an order now for what is there, you're going to get lots of freebies. So I guess we could promote that.
What kind of vest are we getting?
Not Patagonia, because the price point of Patagonia, although they're beautiful, is pretty high. And I'm not sure there'd be a lot of demand for it. But they found another alternative, which apparently is quite appealing. I've not seen them. I don't know. That's Angelica and the team are on that.
All right.
Okay. All good?
You don't want to talk about the...
I can mention it. So I'm heading to Norway in October. So if there's any listeners in October want to suggest a meetup, going to be in Oslo the last week of October. So reach out if you have an interest in helping me set up a meetup. If there's any demand, we'll see what we can do.
Do you want to say why you're going to Oslo, though? That's the cool part.
We're going to let that sit for a bit.
Oh, man. All right.
Let that sit.
Listeners can be assured that it's for a cool reason.
It's a cool reason. Yeah. Awesome. Okay. As always, you can check us out on LinkedIn. Reach out anytime. On X, we both have Calendly links in our X profiles, as does Mark. So reach out anytime. All good?
All good.
All right. Thanks for listening.